Hi, my name is Indranil Guha. I'm one of the co-founders of MetaCaps.ai, which is an AI-driven personal finance platform. I'm also an investor and a content creator in the personal finance space. Ladies and gentlemen, there's been a dramatic improvement in liquidity conditions in equity markets around the world since last year. And that has helped drive a feverish rally in almost every leading equity market around the world. Here in India, we saw the Nifty rally by a spectacular 20% during the course of 2023, and we are now in 2024, and there are no signs that this rally is about to slow down anytime soon. So what exactly is driving this rally? What is the source of this liquidity? Because only if we are able to identify the source of this liquidity accurately will we be able to objectively assess as to how long this source of liquidity is likely to last, which in turn will determine how long this ongoing liquidity driven rally is likely to sustain. So let's start out by examining how have liquidity driven rallies typically shaped up and panned out in the past. So if you look at the history of equity markets, especially in the last 10-15 years, what you would find is that liquidity driven rallies have almost essentially been triggered as a result of global central banks, especially the Federal Reserve in the US, printing a lot of money and pumping global markets with a lot of liquidity. What do I mean by that? Let's understand that using a few charts. So what you see on the screen right now is a chart which illustrates the Fed's balance sheet size. Well, that's the technical name of this chart. I'm going to break it down for you. In layman's language, what that means is that this chart tells you how much money has the Fed printed in the last 15 years. How many new US dollars has the Fed created since 2008 onwards. In this chart, we can also see that there have been two distinct periods when the Fed has printed money at a very, very aggressive pace. First time this happened was after 2008 when this red line went up at a very steep pace, and the second time this happened was after 2020 when again we can see the red line went up at a very steep pace. So whenever this red line is going up at a very steep pace, this basically means Fed is printing money at a very fast pace during this time. And whenever the Fed is printing money at a very fast pace, this process is called quantitative easing, QE. Why did the Fed have to do QE in 2008 and again in 2020? Basically, the US economy faced one of its worst recessions in 2008. And in response, the Fed had to come and provide liquidity support both to the economy as well as equity markets by printing a lot of money and pumping liquidity into the markets. So that's why the Fed conducted QE after 2008. And the same thing happened in 2020 once again. As a result of the COVID pandemic, the US went into a recession once again, and in response, the Fed had to come to the rescue of the markets and the economy, and it had to print a lot of money. In fact, in the QE that followed COVID, we had almost $5 trillion being printed by the Fed between 2020 and 2022. What is the impact of money printing on equity markets? Well, what you have to understand about money printing is that when money printing happens in the US, obviously the amount of cash that comes into the financial system, that starts to go up, and that obviously helps improve liquidity in almost every asset market. But the special thing about money printing in US is that when you have money printing happening in US, these newly created dollars, the circulation of these newly created dollars is not limited only to the US financial system, because you have what are called FIIs, foreign institutional investors, who bring a part of these newly created dollars from US to almost every leading emerging market around the world, including India. And as a result, when you have money printing happening in US, a lot of those dollars end up in emerging markets, and that helps improve liquidity conditions even in emerging markets like India. And that is always a very, very positive thing to happen for equity markets in emerging markets. So how did equity markets in India react in response to money printing in the US? Obviously, the response was very, very good. What you see on the screen right now is this blue line. The blue line is the chart illustrating how the Nifty moved in tandem with the Fed's balance sheet size. As you can see, we can clearly see that after 2008 as well as after 2020, when the Fed printed money, when the red line went up very, very steeply, that provided liquidity support to Indian markets, and the Nifty also rallied very, very strongly on both these occasions. So this relationship seems to be very, very tight. When the Fed prints money in the US, liquidity in emerging markets improve and equity markets tend to do very well during such times. But ladies and gentlemen, that's not what is happening right now. As of now, the Fed is not really printing money or pumping liquidity into the markets. In fact, as we speak, the Fed is cutting liquidity and engaging in what is called QT, Quantitative Tightening. So there have been two occasions in the last 15 years when the Fed has had to do QT. So the first time the Fed had to do QT was between 2017 and 2019. And the second time the Fed started doing QT was from June of 2022 onwards, and mind you, this second QT is still on. So what exactly happens during QT? As I just mentioned, QT is the period when the Fed is actually cutting liquidity. This is the period when this red line, the Fed's balance sheet size, is coming down. On both occasions, we see that this red line is actually coming down, and the red line coming down signifies that the Fed is cutting liquidity. What is the impact of Fed cutting liquidity as part of the QT process? What is the impact of that on equity markets? For that, let's take a closer look at what actually happened to equity markets during the first QT that the Fed conducted between 2017 and 2019. So let's do a deep dive. This is the same chart. We are just taking a close-up view of this same chart between the periods between the years 2017 and 2019. As you can see, the Fed started doing QT from October 2017 onwards. After that, as you can see, this red line started to gradually come down. The red line gradually coming down, basically this signifies that the Fed is cutting liquidity. At the beginning of QT in October 2017, this red line was at approximately $4.5 trillion. That was the size of the Fed's balance sheet size. By the time the Fed was done with QT, somewhere around September of 2019, this red line had come down to almost $3.75 trillion. So the Fed's balance sheet size had shrunk from $4.5 trillion down to about $3.75 trillion. So that's a reduction of $0.75 trillion. In other words, $750 billion. That's the amount of liquidity that the Fed withdrew during the 2-year period between October 2017 and September 2019 when the Fed was conducting QT. So that's a humongous amount of liquidity that was withdrawn. What was the impact of that on equity markets? Well, I just explained to you a little while back that when the Fed is printing money and boosting liquidity, that has historically almost always been very, very good for equity markets. So it has got to be obvious that when Fed is cutting liquidity, that can never be a good thing for equity markets, and we can see that very clearly in this chart as well. As soon as the Fed started to started the QT process from October 2017 onwards, the blue line, the Nifty, that became extremely volatile. You can see it went up, it went down, again it went up, again it came down, again it went up, again it came down. Basically, after October of 2017, the Nifty tried to make a new high 3 times, but as you can see, it could not sustain these highs even in any of these occasions. Every time it would make a new high and it would give up all these gains. We will get a correction in the Nifty. So that's how volatile Nifty became once Fed started conducting QT, and it was not a story of only Nifty. Practically every leading stock market behaved exactly in the same manner once the Fed started doing QT from 2017 onwards. So this is the impact of QT on equity markets. The other thing that is noteworthy in this chart is that something happened around September of 2019. As you can see, from October 2017 all the way up to September 2019, that's a period of almost 2 years, the Fed conducted QT, and this is the period when the red line gradually came down. But something happened in September 2019 because of which very abruptly this red line stopped going down, and in fact, what we can see is after September 2019, this red line quite abruptly started going up once again. This basically signifies that something happened in September 2019 because of which the Fed was forced to reverse policy, change its monetary policy. It had to abandon QT and it had to quite literally overnight go back to money printing. It had to go back to quantitative easing. So that's something quite dramatic. So what is it that happened in September 2019 that forced the Fed to reverse policy and abandon QT and move towards money printing quite literally overnight? If you have to understand what really transpired in September 2019, the root cause of that lay 2 months before that in events that unfolded sometime around July of 2019. This particular event was basically a political development that came around in the US Congress. US Congress is basically the parliament of US. And this political development is called the US debt ceiling deal. Now you must be wondering what exactly is the US debt ceiling and what is this US debt ceiling about. So try and understand it this way. How does any government raise resources for its various spending items? What is the primary source of revenue? It's basically taxes. Every government has to impose taxes on its citizens and companies in order to raise money for its various spending program. But taxes are never enough. There's always a shortfall, and in order to cover this shortfall, every government has to borrow. And how does a government borrow? When you and I have to borrow, we go to a bank to take a loan. But when a government has to borrow, it doesn't go to a bank. It basically issues what are called government bonds, and then they sell these bonds. And anybody can invest in these bonds and they can buy these bonds. And anybody who is investing in these bonds is essentially lending to the government. And that's how US government basically borrows from the market. Now, when it comes to US government's borrowings, what you also need to understand is that there is a law in the US which puts a cap, which limits the amount of money that the US government can borrow. So once this limit is hit, US government cannot issue bonds and cannot borrow anymore from the market after this limit has been hit. And this limit up to which the US government can borrow, this limit is called the US debt ceiling. It's called the ceiling because the government cannot borrow beyond this ceiling. And once this ceiling is hit, the government has to stop issuing bonds and it has to go back to the US Parliament. The US Parliament is also called the US Congress. It has to basically go back and seek permission of the US Congress to raise this limit, to increase this limit so that they can start borrowing afresh. Now, when this matter reaches the US Congress, you have two rival parties there. You have the Republicans and you have the Democrats. And once this matter reaches there, both these parties start squabbling. They engage in very, very hectic negotiations. Now, usually there is no dispute with respect to raising the debt limit. That's not something that either party ever opposes. What they can't usually agree on is once this debt limit is going to be raised and the US government is going to borrow an additional amount, what this additional amount is should be spent on. That's something on which the two parties cannot agree on. Because both these parties have their own political agendas and both these parties want this additional amount of debt to be spent on programs and projects that are aligned with their own political agenda. And that's why they squabble, they negotiate very hard, they push hard on some of the items, they have to give concession on others, but ultimately a deal is reached. Ultimately, both the parties come together and then they agree on a deal. And once this deal is reached, a law is passed. As part of that, the US debt ceiling is raised. And once the debt ceiling is raised, the US government basically gets the permission that it needs to go back to the bond market and it can again start to issue bonds and it can start to borrow all over again. Now, one more thing that you need to understand with respect to governments borrowing money by selling bonds is that whether or not a government will be able to find investors for its bonds depends on what's the kind of credibility that the government enjoys amongst investors. Now, usually, if an economy is not very well managed, let's say you have an economy like Zimbabwe or Venezuela, where inflation is very high, the economy is not very well managed, investors do not have a lot of confidence on that kind of a country's bond. And if that kind of a country comes to the bond market to sell its bonds, that kind of a government is going to find it very difficult to sell its bonds. Even if it's able to find investors, such investors are going to insist on very high interest rate in order to compensate for the risk. But that's not the case with US government bonds. Because US government enjoys a humongous amount of credibility amongst investors, and that's why there is always a very large amount of appetite amongst investors to invest in US government bonds. Because basically nobody expects the US government to ever default on their bonds, and that's why universally US government bonds are considered to be world's most risk-free investment. And that's why there is always a lot of demand for US government bonds. But the flip side of that is that when the US government comes to the bond market to sell its bonds, and especially if it is selling its bonds in very large quantities, then that has a very adverse impact on the overall liquidity conditions of the US financial system. Because think about it this way, the total amount of money, the total amount of liquidity that is available with investors to invest in stocks and bonds, that is limited. And in this backdrop, when US government comes to the bond market to sell its bonds, US government will be able to sell whatever amount of bonds they want to sell, and they will be able to raise whatever amount of money they want to raise. But in the process, the overall amount of liquidity that is left with investors, that would have gone down to the extent that US government has issued bonds. So basically, let's say if the US government has come and sold bonds worth $100 billion, then the total amount of money that is left with investors to invest in other stocks and bonds, that would have gone down by $100 billion after US government has successfully sold all the bonds that it wants to sell. So that leads to liquidity conditions in the US financial system to go down when US government starts selling bonds in very large quantities. And that's especially adverse for liquidity conditions if this happens at a time when liquidity conditions are already very tight. So this is exactly what happened in 2019. We already had the Fed cutting liquidity as part of its quantitative tightening program, and then in July of 2019 we had the US debt ceiling deal coming through, as part of which the US debt ceiling was raised. And as soon as the US debt ceiling was raised, the US government started issuing large quantities of US government bonds, and in the process it ended up worsening liquidity conditions even further. So what was the impact of all this on liquidity in terms of hard numbers? So this is how it looks like. Before the debt ceiling deal was passed, the Fed was already cutting liquidity at a rate of $30 billion per month. And then in July, the US debt ceiling was raised, and the US government came into the bond market. And in the very first month after the US debt ceiling was raised, the US government ended up selling US government bonds worth more than $100 billion. So the rate of liquidity reduction, which before the debt ceiling deal was only $30 billion per month, it went up to $30 billion plus another $100 billion. So $130 billion per month. So the rate of liquidity reduction went up more than 4 times as a result of the US debt ceiling being raised. And whenever you have liquidity conditions worsening so dramatically in a short period of time, you are bound to get a crisis in the financial system. And this is exactly what happened. By September of 2019, within just 2 months of the US debt ceiling being raised, we got a crisis. But interestingly, this crisis was not witnessed first in the equity markets. Instead, this crisis manifested itself first in what is called the repo market of US. We had what is called the blow-up in the US repo market. Now you must be wondering what exactly is the repo market and what was this US repo market blow-up all about. So this is how it works. The repo market is basically an interbank lending market where banks lend to each other. Now you must be wondering, why do banks have to lend to each other? Now, this is crucial for the functioning of the banking system. Think about it this way. What is the primary function of any commercial bank? There are 2 primary functions of a commercial bank. On any given business day, firstly, every commercial bank receives deposits from depositors who want to park their cash with the bank, and secondly, banks have to give out loans to those who want to borrow from the bank. So you could have a situation that on a given business day, one particular bank receives more cash in deposits than the amount of loans that it has given out on that day. So this particular bank is going to end up with a cash surplus at the end of business day. At the same time, you could have another bank which could have given out more loans on that day than the amount of deposits that it has received on that day. This other bank is going to end up with a cash deficit. Now, this is where the role of the repo market comes into play. At the end of business day, all these cash deficit banks will go to the repo market and they will look for banks which have a cash surplus on that day, and they will try to borrow money from the cash surplus banks in the repo market. And the rate of interest that banks charge each other while lending in the repo market is called the repo rate. The repo rate of any country is set by the central bank of that country. Here in India, the repo rate is set by the RBI. In US, the repo rate is set by the Federal Reserve, the Fed. Now, back in 2019, the Fed mandated repo rate, the rate at which Fed wanted banks to lend to each other, that was set at about 2%. Now, what has this got to do with the liquidity conditions that were prevailing back in 2019? Now, as I mentioned to you, back in 2019, we had extremely tight liquidity conditions. Firstly, we had the Fed cutting liquidity as part of its QT program at a rate of $30 billion per month. And then we had the US debt ceiling deal coming in, and the US debt ceiling was raised, post which the US government started issuing bonds at a rate of over $100 billion per month. So the rate of liquidity reduction went up from $30 billion per month before the debt ceiling deal. It went up to 30 plus 100, $130 billion per month. And this led to so tight liquidity conditions that within just 2 months of the debt ceiling being raised, we had a situation where there was practically no bank left in the US banking system which had any material amount of surplus cash that they could lend to another bank. Now just imagine, if you are a US bank which is operating under such severely tight liquidity conditions, and if you have some amount of cash left with you that you can potentially lend to another bank, are you going to lend it away at a rate of just 2% that at which the Fed wants you to lend this money at, or are you going to demand a much higher rate of interest because given the tight liquidity conditions? Of course, you are going to demand a much higher interest rate. And that's exactly what happened on the night of September 17, 2019. Against the Fed mandated rate of 2%, the effective repo rate on the night of 17 September 2019 in the US repo market shot up to 5.25%. From 2%, 5.25%, more than doubled. In fact, this was the 5.25% was the repo rate at the end of business day. Intraday, this rate went up to as high as 10%. So one US bank demanding an interest rate of 10% to lend money to another US bank, that effectively means that there is no cash left in the US banking system. And if banks are not able to source cash, borrow cash from another bank at a reasonable rate of interest, that has grave consequences for the functioning of the banking system. And when you have a situation like that, all the banks would basically go and end up at the Fed's door, because after all, it's the Fed which has set the repo rate at 2%. So it's the Fed's legal obligation to make cash available to banks at the Fed mandated rate of 2% if they are not able to source cash from other banks at that rate. So every bank basically ended up at the Fed's doors and started demanding that the Fed makes good on the promise of making cash available to them at the Fed mandated rate of 2%. And where is the Fed going to get the money from to make that cash available to banks? Well, the only way the Fed can get that cash is by restarting money printing. And that's exactly what happened on the night of 17 September 2019. The Fed had to abruptly wind down the QT program and it had to go back to money printing overnight. And as a result, you can see that from 17 September 2019 onwards, we had the red line starting to go up again. The red line starting to go up again basically means the Fed Fed pivoted from QT back to money printing. And as the Fed started to print money all over again, the equity markets also responded immediately. We had a huge breakout in Nifty also. So this is the story of how the first QT from 2017 to 2019 shaped up. Now let's take a quick look at what's been happening in equity markets during the course of the second QT, which started from June of 2022 onwards, and as I mentioned, this particular QT is still on. So let's take a closer look at what's been happening in the markets since early 2022. So this is the close-up view of what's been happening in equity markets since early 2022. As I mentioned to you, from June 2022 onwards, the Fed started conducting QT for the second time. And as the Fed started to conduct QT, we can see that this red line started to come down, which basically means that Fed started to cut liquidity. We can also see that around March of 2023, there was a brief spike in this red line. The red line started to shoot up all over again very, very briefly. Why did this happen? Basically, there was a banking crisis of sorts in amongst the small regional banks of US. A bunch of these small regional banks started to go bankrupt around March of 2023, and the Fed had to come to the rescue of these banks, and the only way the Fed could rescue these banks was by providing liquidity support to them by going back to money printing. And as a result, we had a situation where the red line started to spike again very, very briefly. But this situation was contained very quickly, and the banking crisis was resolved. And as soon as the banking crisis was resolved, we can see that Fed resumed QT and the red line started to go down all over again, which means the Fed once again started to cut liquidity. On top of this, in June of 2023, we had one more instance of the US debt ceiling deal being reached in the US. And as soon as the US debt ceiling deal was reached, we had the US debt ceiling being raised once again in June of 2023, and we had US government coming into the bond market and starting to issue government bonds. So we see once again there's a repeat of the same story that we witnessed back in 2019, when we had the Fed already cutting liquidity as part of the QT program, and on top of that, we had the debt ceiling coming through, after which the US government started to worsen liquidity conditions even further by starting to issue huge quantities of US government bonds. What was the impact of this on liquidity conditions in terms of hard numbers? This is how the numbers look like. The Fed was already cutting liquidity at a rate of $95 billion per month during the second QT from June 2022 onwards. And then in June of 2023, we had the US debt ceiling deal being reached, post which in the very first month, the US government ended up issuing US government bonds worth more than $100 billion. So the rate of liquidity reduction, which was $95 billion per month before the debt ceiling deal, post the debt ceiling deal, the rate of liquidity reduction went up to $95 billion plus another $100 billion. So total $195 billion. So the rate of liquidity reduction effectively doubled once the US debt ceiling was raised in June of 2023. Now you must be wondering that after debt ceiling deal, we had liquidity conditions becoming so tight because of the actions of the Fed cutting liquidity as well as the US government issuing record amounts of government bonds. Then how is it that I mentioned at the beginning of this video that there was a dramatic improvement in liquidity conditions since middle of 2023? There seems to be some disconnect here, right? And what is even more surprising is that despite liquidity conditions becoming so tight because of the actions of the Fed and the US government, there seems to be no impact on equity markets. Because especially since the debt ceiling deal, what we have had is that Nifty has rallied almost 18%. So there's a complete divergence between the liquidity conditions that has prevailed in the markets and what's happening to equity markets. So what are we missing here? So the missing piece is this third factor that was impacting liquidity during the course of 2023, and this third factor was the RRP, the reverse repo facility. Before I explain to you what is the RRP, I want to take you back to this chart that I showed you towards the beginning of this video, where I was trying to explain to you how much money the Fed printed during the course of the COVID pandemic. As we saw, during the COVID pandemic, the Fed printed a staggering $5 trillion between 2020 and 2022 in order to provide liquidity support to the US economy as well as to equity markets. What happened to all this money? Most of this money ended up with the US government, and the US government used a good part of this money in order to provide financial support to its citizens, especially those citizens who had lost their jobs or were impacted by COVID in any manner whatsoever. So we had very large scale transfers happening from the government into the bank account of affected people. And when you have such large scale transfers happening from the government into the bank account of citizens, there is a deluge of cash, there is a deluge of deposits in the banking system. And the result of that is that the interest rate that is offered by banks to depositors, that collapses. Why so? Because think about it this way, why do banks have to offer an interest to you on your deposits? Banks have to offer an interest to you in order to attract deposits. But if you have a condition like COVID, where there is already a deluge of deposits, there is already overwhelming amount of deposit that is coming into your bank that wants to get parked with your bank, then you don't, as a bank, you don't have to offer a very high interest rate in order to attract these deposits. In fact, during COVID, the condition was so extreme that as a bank, you didn't have to offer any interest rate at all. So the interest rate across the US banking system during COVID practically collapsed to zero. And yet the amount of deposits that were coming into the banking system was showing no signs of slowing down. And at one point, there was this very real risk that interest rates in the US banking system could turn negative. And if interest rates turn negative, that gives rise to a condition called deflation, which is a very, very adverse condition for any economy to be in. This is something that has been experienced in Europe, this is something that has been experienced in Japan, and the US Fed was absolutely determined that they would prevent interest rates in US from turning negative at any cost. And what was the means through which US Fed was going to ensure that interest rate doesn't turn negative in US? They basically revived this facility called the RRP, or the reverse repo facility. So the intent of the Fed behind reviving the RRP facility was twofold. Firstly, they wanted to, so what they started doing was they revived this facility called RRP. Anybody could park their money in the RRP, and the Fed was offering a small positive interest rate of 0.15% per annum on the RRP balances. So basically the Fed, through the RRP, was offering an option to depositors to park their money and get a slightly higher interest rate on their deposits compared to practically the zero interest rate that banks were giving them at that point in time. So this was the first intent of the Fed behind reviving the Fed RRP facility. The second and the most important intent of the Fed behind reviving the RRP facility was that as long as the Fed was offering a positive interest rate on the RRP, banks could not take their interest rates to negative territory, because if banks start charging a negative interest rates, everybody would withdraw their deposits from bank and move that money into the RRP. By the way, as a depositor, you could not directly deposit your money into the RRP. RRP was not directly accessible to retail depositors. However, you could access the RRP through what are called money market funds, which are like debt funds. You could invest in these debt funds, and through these debt funds, these debt funds would in turn invest in the RRP, and that's how through the RRP, even retail depositors could access and enjoy the positive interest rate that was offered by this 0.15% interest rate that was offered by the Fed on the RRP balance. Now this 0.15% per annum, this is the starting interest rate that the Fed was offering on the RRP facility back in 2021. After 2021, the US economy started to slowly recover from the ravages of the COVID pandemic. And as the recovery started, inflation started to rise in the US economy, as inflation started to go up, But interest rates in the Fed also started hiking interest rates. And as Fed started to hike interest rates, the interest that Fed started to pay on the RRP also started to go up. And as we speak, the interest rate that the Fed is now paying on the RRP facility as of now stands at a staggering 5.3% per annum. So what started off as just 0.15% per annum has now gone up to 5.3% per annum, which is a very, very high interest rate by US standards. And as interest rate offered by the Fed on the RRP facility went up, so did the inflows into the RRP. So what you see on the screen right now is the chart which shows how the balance in the RRP went up between 2021 and 2023. So as you can see, to begin with, in 2021 the balance in the RRP was practically zero, but as interest rate offered by the Fed on the RRP facility started to go up, a record amount of flows started to come into the RRP facility, and as you can see, by early 2023 the balance in the RRP had reached a staggering level of almost $2.4 trillion. So what the Fed was able to ensure is that it was able to create this liquidity pool in the form of RRP, and this liquidity pool could provide liquidity support to rest of the US financial system and other asset markets at a time when the Fed itself was doing QT and could not directly support asset markets. So this was a very smart thing that the Fed was able to do. So what happened after the US debt ceiling deal? I told you that once the US debt ceiling deal was passed, the Fed was already cutting liquidity as part of its QT program by $95 billion per month. On top of that, the US government is further worsening liquidity by issuing government bonds worth almost $100 billion per month. So you have a total 95 plus 100, $195 billion worth of liquidity being taken out every month. But to offset this, what we have had since the debt ceiling deal is $1.8 trillion have flown out of the RRP. If you look at it in terms on a monthly basis, we have had more than $200 billion per month flowing out of the RRP since the debt ceiling deal. So we had $195 billion going out worth of liquidity being cut, but against that the RRP completely offset the impact of the liquidity reduction caused by the actions of the Fed and the US government issuing government bonds. So in fact, so much so that the amount of money that came out of the RRP was in fact more than the amount of liquidity that was being cut as a result of the actions of the Fed and the US government. So what we have had since June of 2023 is that liquidity conditions on a net basis has been positive because more money has flown out of the RRP to provide liquidity support to asset markets than the amount of liquidity that has been removed from the financial system as a result of the actions of the Fed and US government issuing bonds. And this net positive liquidity condition is what has helped drive the feverish rallies that we have seen in equity markets around the world. But ladies and gentlemen, can this party last forever? Well, I don't think so. As we can see in this chart itself, compared to its peak balance of almost $2.4 trillion, the RRP balance is now depleted to the extent of almost 75%. What we are left with is only $550 billion in the RRP. And if the RRP continues to be drained at the rate at which it has been for the last 7 to 8 months, this $550 billion will also be gone in the next maximum 2.5 to 3 months. And when that happens, we will have one of the most important source of liquidity support for equity markets around the world will be completely exhausted. And that will pose a very serious challenge to the continuation of the rally that we have been seeing since last year. So what are the implications of the RRP being fully exhausted for the equity markets? Well, clearly, once the RRP is fully exhausted, there will be no liquidity pool left in the financial system that can offset the impact of the Fed cutting liquidity as part of its QT program and the US government further worsening liquidity by issuing government bonds. So once the RRP balance goes to zero and the RRP is fully exhausted, we'll almost certainly have liquidity conditions tightening very severely, and that could lead to an adverse outcome for equity markets. Now, I'm not trying to suggest that some kind of a crash is imminent in equity markets, because clearly a number of outcomes are possible. It's entirely possible that the Fed could take proactive cognizance of the worsening liquidity conditions, and as a result, the Fed could proactively slow down the rate of QT, or it could stop the QT program altogether. And if that happens, that would clearly provide a lot of relief to equity markets. At the same time, what is also entirely possible is that the Fed does nothing and it allows liquidity conditions to progressively get worse till something really bad happens to asset markets. And if that happens, that would almost certainly force the Fed to abandon QT and possibly even go back to money printing. And if indeed the Fed goes back to money printing, then we could have a situation that there could be some drawdown in equity markets initially as a result of worsening liquidity, followed by the Fed intervening, and then because of the money printing restarting, the Nifty could resume its next leg of rally. Now, the purpose of this video is not to speculate on the possible outcomes. The primary purpose of this video is to equip you with the understanding of RRP, because once you understand how the RRP works, you will be able to gauge for yourself how the liquidity conditions are changing in the global financial system, and as and when the RRP balance is completely exhausted, liquidity conditions become very, very tight, you will be in a very good position to take appropriate action with your equity portfolio. That's the primary purpose of shooting this video. Ladies and gentlemen, I'll bring this video to an end here. I hope you liked what I presented in this video. If you did, then please do like and share this video. Thank you very much.